Alan Kohler here, and I'm talking to Robert Towner, who is the CEO of Triangle Energy Limited. Now, if you listened to Money Café last week, you would have seen that one of the questions concerned Triangle Energy and how come it's got a market cap of 12 million when it owns a big shareholding in state gas worth 23 million. I thought that was a very good question. So I looked it up and saw that there was some interesting stuff in the balance sheet and booked Robert Towner for an interview because I think if a company is valued on the market at half the value of one of its investments, that looks like an opportunity. But the question is it really an opportunity? And, here's Robert Towner to tell you. He's the CEO of Triangle Energy. Well, Rob, we're talking to you because a subscriber of Eureka Report asked me last week, how come Triangle Energy's market cap is 12 million when it owns $23 million worth of state gas shares? So I looked in the balance sheet and there was this provision of $21 million for restoration of Cliff Head.
Yes.
So we need to talk about Cliff Head.
Yeah.
So is that an actual liability that you're going to have to spend?
The answer to that, Alan, comes down to what will actually happen to the field. Under our current reserves and life of production, that is the requirement under our current reserve, which is effectively out to 2024-25.
So you would need to spend that in 2025 or something, would you?
No. The field would close, let's call it, in 2025, and then we've got to make good. That's how it is for most things, be it hard rock mining or offshore oil and gas or onshore oil and gas for that matter. And it depends on how you look at that situation. I'm the managing director of a business that's also in the business of finding more oil and gas, and the Cliffhead oil field's been producing since 2006. It's operated without any incidents of any major occurrence. Environmentally, we've done everything that's required. There's been no problems. And so there is this provision for decommissioning. Now, there's three sections of the Cliffhead oil field infrastructure. There's the offshore platform. There's 12 kilometres of pipeline, and the beach access. And then onshore we have a separation facility, which separates the oil and the water to produce the crude, which can handle up to 15,000 barrels, and is the only infrastructure of that size. Is a smaller separation plant just to the north of us. But the reason I'm going down to this point of answering your question is that even at Cliff Head at the moment, we've made announcements to the ASX that we've got potential to drill 2 development wells to recover 1 million barrels each, and we have an exploration well.
How do you know there's 1 million barrels to be recovered from 2 wells?
We've spent the last 2.5 years reinterpreting all the original and subsequent seismic data using more modern techniques to interpret that data. It all has to be signed off as anything would in that instance. And we have gone to start preparing for that now. So I guess that what I'm saying is that development wells, not exploration wells. They are 1 kilometre or 1 to 1.5 kilometres from our existing platform, so they can be drilled from that platform. So I guess I have a habit now. Everyone seems to understand hard rock mining, and you do infill drilling. This is no different. And
so have you done any drilling at all since 2006?
Not on this project, no. Oh, sorry, in 2006, no. And that was one of the reasons why I found this opportunity attractive for the infrastructure in place, because there is more oil to be found, and if not, developed, really, is what I'm saying. And it's quite well documented within the joint venture's history that there was these opportunities. It's just that they've never been done. You've seen the oil price fall in 2014. That's now almost coming up to 10 years ago. We took that opportunity of being a counter-cyclical investment proposal. And now you're looking at oil back to 77 and the quick recovery and the lack of exploration and development, which is well documented now in most oil and gas publications, that we might well see something we haven't seen in a long time, is these oil price rises that are quite hard and fast because of the lack of investment. And that's exactly the micro model for Cliff Head, there has been no development expenditure investment since the field went on production in 2006.
So how much of it do you own?
Triangle own 78.25%, sorry, 78.75%. In the accounts, however, we only account for 57.5%, and that's just the way the structures of the joint venture is. We own 100% of 57.5%, and we own 50% of the other 42.5%, and the other 50% of that 42.5% is owned by ByAlan Energy. So we can't account for our full 78% because we don't control the other entity. We only have half of it.
But presumably you're the operator and you control the joint venture.
That's right.
So how much does it produce now?
We're currently doing 720 barrels a day. We've got 2 workovers going on at the moment on 2 wells, which will lift production. When I say workovers, we're replacing a pump in 1 well and restructuring the production on the 2nd well. That will bring it back to approximately 820 barrels a day.
And where are you selling the oil to? Who buys it off you?
So at the moment, we're sending that down to the old Kwinana refinery where we have a storage and handling agreement. And we have announced that we are in a non-binding to go binding agreement with BP Singapore. So we'll ship the crude to a refinery in Singapore. And
you'll sell it at the refinery gate, or you sell
when it leaves Kwinana?
You'll sell it from Kwinana.
We have been delivering since the BP refinery closed in March this year. We've continued to produce and continue to deliver and store, and we have sent 1 shipment off.
So, and what do you get for that oil?
We're getting effectively a Brent crude price less our shipping and handling costs.
So 76 or 77 US a barrel.
Yeah.
And so what's your cash flow then?
So our last payment was approximately 1.6 million US. Historically, when the BP refinery was receiving our crude oil, we'd get paid monthly. And they call it, let's just say, generalisation, not generalisation, but sort of smoothing it out over the last few years with $60 to $70 oil. The operation at Cliff Head would make $2 to $4 million a year.
Right, and what's your margin?
Well, that's our gross profit.
Oh, that's your profit, right?
Yeah.
And you just take us through what you're spending that on.
So the interesting thing, Triangle bought Cliff Head and it was a pure production play. Subsequent to that, we went into a joint venture to drill the Xanadu well. So we've got an exploration profile started in 2017. That was a well again in the Perth Basin south of Cliff Head. So that was a well that we contributed about $2.2 million towards. So along the way and coming to where we are now, we've continued to acquire other licenses in the Perth Basin. We've now got 100% of the Mount Horner onshore oil field. Again, another field that's produced 1.7 million barrels historically, has been closed in since 2014. So to answer your question, there's obviously administration costs, there's the listing costs, the standard thing, and that would come out of that. We've raised capital along the way for more the exploration requirements. The Xanadu well was a discovery, but not commercial on the quantities of oil that we found there. And I've got seismic coming up. We've just raised $10 million. So it's an interesting scenario. People just assume revenue. Well, not assume, the Cliff Head oil field was never going to fully fund the development of what Triangle wanted to have at the end of 5 years, which was to have a predominant position for conventional oil in the Perth Basin. We don't have any other operations for oil and gas outside our equity investment in state gas.
Right. Okay. So the advantage of the Cliff Head development wells are that they can be drilled from the existing platform. So that means they'll be how much will they cost then?
We're doing final numbers now, but it's looking like they could be anywhere for sort of between the $12 to $15 million mark each. It will depend, however, which we haven't got to the final decision as to will we do the 2 development wells and the exploration well. But we will know that in the next 2 months on that decision.
Right.
It's all about effectively, Alan, the mobilisation. If you mobilise once, do you do the 3 because you don't have to demobilise and go back again, obviously?
Yeah. But are you going to raise equity for that spending?
Look, we attended one of the conferences in Perth recently just to put out there the opportunity. We have had some interest. People would like to go to the data room to have a look at what we've discovered. We would consider farming partners as well. And we are in that process, I suppose, of people looking at the opportunity. One of the advantages we have, I look at, is that we have combined interests of 100% on our onshore assets and 78% in the Cliff Head field, oil field, and 78% of the much larger offshore exploration license surrounding Cliff Head. So we've got operatorship on 4 projects and high ownership. And in this game that we're in with oil and gas, we're not big enough to take on 100%. So we would consider taking partners on that could, join us to fund that drilling.
And if you found a million barrels, as you expect, would that restoration liability come off your balance sheet or stay there and just be stretched, be put out in the time frame?
We believe the 2 projects, the chance of success is high, so it'd actually be 2 million barrels, and that would extend the life to around 2030, and it would also bring the production to around 3,000 barrels a day. So the answer is yes. We would resubmit our environmental plans to extend the life of the infrastructure.
Yeah, right. But would that liability stay on your balance sheet?
It stays in the balance sheet, but it'll be more relative to the life of the field as well. And remembering that with 3,000 barrels a day and the lift in production, we did announce within this capital raising, I'm going to set up a decommissioning or an infrastructure fund, which is really set there to set aside some money in that and the oil prices continue to be good, we can add some more in. Or secondly, if we do extend the life of the field, there will be a mechanism to utilise some of that money to go towards infrastructure upgrades. Remembering, if these oil prices stay the way they are, you're going to see a lot of the bigger oil players and producers having significant amounts of cash that, of course, they'll probably hand back to shareholders. But in this game, they'll also say, well, where can we go to extend our exploration, the life of their assets? I mean, that's how I look at it. I've done a triangle. We've done a pretty good job in building up a very large portfolio of conventional oil assets in the Perth Basin, which is quite well acknowledged at the moment as one of Australia's most underexplored oil and gas basins. It's only 5 or 6 years ago you had the likes of Waitsia and more recently West Eureka gas fields come up. That's after a long period of time of no investment. So, I think there's a lot of opportunity where we are, and I think the oil price is definitely showing a change.
Are any of the big oil companies nearby? Are you sharing the Perth Basin with anyone significant?
Well, only on the gas side. On the gas side, you've got Beach and Mitsui. Strike Energy, which was a company no different in valuation to Triangle, 2-3 years ago, now has a market capitalisation of 500, 600 million. You've got Warrego Energy, who's the partner in West Eureka with Strike. Their capitalisation is about 300 million. So the answer is Beach and Mitsui are there with their Waitsia gas field.
Do you think one of them might come and buy you?
I don't think. I don't know. I mean, the question there simply comes down to whether they want to move from or into both oil and gas. I don't know. I think it's more likely that you'd see one of the more conventional oil and gas larger companies look at it just because of the scale of the project. We've got just under 10,000 square kilometres of acreage, both on and offshore. And if someone's looking conventional oil, Triangle has got the only option.
Have you got gas as well, or just oil?
We are looking at Mount Horn at the onshore project and reinterpreting old data on that at the moment. We're going to run seismic on that at the end of the year, but we believe there could be gas deeper than the current oil opportunities. The project sits directly north and adjoins the Waitsia gas project to the south. Different structures, obviously, but we are certainly looking into that at the moment.
What do you think of the way energy policy in this country is going?
I find it interesting that we have used words like energy security. I believe there's a big mismatch between the federal government's policies and the state government's policies. I mean, within the state governments, oil and gas companies have commitments to spend money to go and find hydrocarbons, aside from the environmental world that we live in. And yet, at the moment, and particularly in Western Australia, we no longer have a refinery, and I have to ship my oil currently overseas. And we've seen a lot of money go into renewables, and that started 20 years ago. I'm not against renewables. I'm not against saving the environment. But we seem to, in this country, have lost the investment appetite to process our own hydrocarbons. What are the two big industries in this country? Agriculture and mining. And they're both remote. So, you talk about energy security. Oh, God, we've got a problem. We've got to wait for it to come into Kwinana and then hope we can get it in time to the mining companies for their diesel. They're still going to need diesel in the short term. And that's where I find it interesting. There needs to be a real addressing the fact that we can and do have hydrocarbons, and I use the word stored, in reservoirs below the ground. And the federal government's throwing money at people building tanks to import refined fuels to store it above the ground. Well, give me $20 million, $50 million, I'll go and drill some more holes and get it out. And you won't need the tanks because we'll process it in our own refinery. But that's what we've got to do now. We're scrambling around trying to find a way to solve the problem, particularly in Western Australia.
Australia has a problem of added value in general, really, don't we?
Has for decades.
Yeah. Interesting to talk to you, Rob. Thank you so much.
Pleasure. Thank you, Alan.
That was Robert Towner, the CEO of Triangle Energy.